Good afternoon, everybody, and welcome to the latest in our series of professional advisors working lunches. Oh, whoever that is, could you please mute? I'm Tom Ellis, editor of Professional Advisor, and I'll be your host for today. Your portfolio is about to get punched. Our partners for this event, Ruffer, will tell you in the next hour, and low-risk portfolios might be the most vulnerable. A few weeks ago, Ruffer told our working lunch delegates about the risk of inflation, but today they will assess the first quarter of 2021 and why some dynamics of the next market regime are already visible. We're joined today by two expert speakers from our partners, Ruffer, who will discuss why the balanced portfolio might be beginning to look a bit unbalanced. They are Ruffer's investment director and co-manager of the Ruffer Total Return Fund, Matt Smith, and Matt will be in conversation with their business development manager, Josh Gunson. Now, before we start today's session, I'm just going to briefly run through the obligatory housekeeping notes. As I said a minute ago, your microphones and cameras are currently switched off, and we'd be most grateful if you'd be kind enough to keep them that way. It will ensure there's no background noise so the speakers can be heard more clearly. To start the session, we'll be running a brief poll, so please do participate as your responses will influence the presentations you're about to see. And there will be time for a Q&A session at the end of this presentation, so do please feel free to ask any questions to Matt and Josh using the chat function, which you will find at the bottom of your screen. If you wish to remain anonymous, simply select my name from the drop-down list in that chat box before you type your message. That way only I can see it. I'll endeavour to put all your questions to our speakers at the end of this session. I should also inform you that this session is being recorded and we will send you the link to the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link to the recording of the session. And now, for that CPD, here are today's learning objectives. So quickly, explain the changing role conventional bonds play in balanced portfolios, explain the current macroeconomic environment for equities, identify and compare different asset classes when investing in an inflationary environment, and identify and explain how this relates to key asset allocation decisions that advisors will have to make in the coming months and years. Okay, that's the housekeeping out of the way. Let's move on to our main event, and let me hand you over to Ruffer's business development manager, Josh Gunson. Over to you, Josh.
Thanks very much, Tom. Hopefully everyone can hear and see me. Good afternoon. So I'll just give you a quick recap as to how this is going to work. Matt will speak for about 20 minutes. We'll then have a short pause and I will reappear and ask Matt a couple of questions. The conversational interlude will last for about 5 minutes. And please pop questions at any time in the chat function. Matt will then speak again for about 20 minutes and then Tom will host a longer Q&A for 15 minutes at the end. To encourage participation, we will be raffling off a very agreeable case of wine. So if you ask a question in the chat, then your name will go into the hat for the raffle at the end. Well, the name will actually go into my trusty bowl, and it will be drawn at the end to announce the winner. So that's an extra incentive to ask some questions. But before we begin, we could start with some polling questions to get you all thinking about some of the topics which Matt will be talking about. Just give it a couple more seconds. So that is interesting. So a lot of advisors out there, it's definitely what I've been seeing in conversations, are concerned about sort of diversification in portfolios. And again, this is a topic is becoming a lot. Is that low risk is something that a lot of advisors are particularly worried about, particularly the low risk clients. And alternatives seem to be, whether it's sort of infrastructure, private equity, is definitely getting more airtime than it has in the past. And correlated returns is the most appealing characteristics. Well, hopefully something Ruffer might be able to help you out in that light. If we could have up the presentation now. Brilliant. So I'll just give you a quick overview of Ruffer, who we are and what we do. So I'm Josh, I'm one of the business development managers at Ruffer, and I'm joined with Matt Smith, one of the co-managers on the Ruffer Total Return Fund. So we tend to think about risk, diversification, and asset allocation quite differently. And one key takeaway today is that we're different, sort of many typical alternatives that advisors use, whether that's private equity, infrastructure, or even absolute return funds. So at Ruffer, we have a single all-weather strategy, and we look after about 20 billion of assets. The Total Return Fund, which Matt co-manages, is our flagship fund. That's just over 3.8 billion of assets. We're completely unbenchmarked, completely unconstrained, and we are go anywhere investors. We focus on capital preservation and all-weather investing, and we'll be doing it whether it's cool or uncool. And at the moment, we believe we're in a profound time of change, and what served investors for a very long time might no longer hold true. So one of our big concerns is that the typical sort of 60-40 portfolio may struggle going ahead. In particular, the role that conventional bonds play as protective assets. This is something to bear in mind for your clients. It's definitely challenging to find diversification in an increasingly correlated world. So if conventional bonds no longer offer the same protective characteristics they once did, then this will impact your clients' asset allocation. Low and medium risk clients might be in riskier positions, might be in riskier portfolios than you might think. So at a high level, maybe the more conventional bonds someone has, maybe the riskier their portfolio. But at Ruffer, we look to offer true diversification. Our returns have come with a low correlation to conventional investment strategies, offering clients a different pattern of returns. So for any advisor who's looking for a diversifier, we think we provide just that. So how have we done? So looking over sort of 26 years, this is 26 years, we've steered our clients through different market conditions, all types of weather, good weather, bad weather, and sort of through 3 market inflection points, which does suggest some skill. And finally, we're not afraid to challenge market certainties and go against the herd. But that's enough from me, and I'll see you in about 15 minutes, and I'll now hand over to Matt.
Thanks, Josh. And good afternoon, everyone. And first of all, thank you for your excellent poll answers, because you've helpfully guided me towards the next slide in a sort of real Blue Peter. Here's one I made earlier. You know, what I think is most important about what we offer at Ruffer is that it is genuinely uncorrelated. You know, we are not using the same assets as everyone else, and that's what we're briefly showing here. The green line is the correlation of the Ruffer portfolio to the equity market, which is represented in performance terms in blue. And what you can see is that when markets fall sharply, we provide negatively correlated returns. So that is genuine protection. And when the market is rising, we offer a solid positive correlation. So that's decent protection in times of stress and solid returns when the sun is shining. But enough about Ruffer. I'm here to talk to you today about 3 different things. Firstly, bonds and the balanced portfolio, and why the lowest risk portfolios, the most bond heavy portfolios, we think will be the most vulnerable. Why we need to listen to Mike Tyson and what on earth he's got to do with markets. And finally, what do we do about it? What's the solution? So let's zoom out for a moment and just think about the dominant market megatrend of the last 40 years. And you know, you all know what that is. It's basically interest rates going from 15 in 1980 to 0 or near 0 now. And what this period started with was very high inflation. That's the newspaper headline from 1980. The US winning the hockey gold medal and inflation hitting 18%. and it's all the way to today with the kind of the death of inflation. What does this interest rate dynamic mean for investors? It means that they have had to engage in a dramatic search for yield. That has had pretty serious consequences for the balanced portfolio. So the first problem that it brings about is that investors have had to take a lot more risk. What I'm showing here is the duration of investment grade credit in years. And as you can see, it's gone from just under 6 in the early 2000s to around 9 years now. That's, effectively what the average maturity of the bond under there is, adjusted for the coupon. And what it means is that basically the rate sensitivity of investment grade credit has risen by around a half in the last 20 years. So invisibly, lowest risk has become higher risk, or at least significantly more sensitive to a move in interest rates. So that's the risk part. In the risk reward equation, let's assess the second bit. Has the reward got any better to reflect that higher risk? Well, as you probably know, the answer is it has not. This is the kind of the running yield on investment grade credit, and as you can see, it's come down from 7 to 2. That reflects both a declining spread, i.e. the kind of the credit risk premium part, and the yield of treasuries underneath. So overall, the risk reward on credit looks pretty unfavorable, and that applies equally to bonds, to government bonds, i.e. sovereign credit and corporate credit. Now, if we combine those two and think about, what does the genuine margin of safety look like for a bond investor? I think this is a really important chart. As the risk has increased and the reward has decreased, the margin of safety has double decreased, if you will. And what this shows is how long it would take for a bond to recoup the loss generated by a 1% rise in yields through the coupon. So you've got to combine both the yield of the bond and its duration. And as you can see, it's, risen basically exclusively since the financial crisis, from 1 to about 7 years now. Why does that matter? It matters because whilst it's not our business to say who should share our view on the direction of interest rates, what this means is that if interest rates rise, the ability of your portfolio to recover from that has decreased very, very substantially. And we kind of know this. You can't allocate to cash, for example, because the return is 0. So therefore, it doesn't offer you any kind of healing potential in a portfolio context. But I think this is a good lens to look at bonds through. You are heavily reliant now on interest rates either falling further or staying low. So that's, it's just a 1% rise in yields. So that's bonds. Obviously, in the balanced portfolio, that's only 40% of the deal. Let's have a look at equities. And it won't come as a surprise that bonds have driven up equity markets too. That's through 2 factors. Firstly, the discount rate. So as bond yields decline, the interest rate at which future profits are discounted back to the present day falls, making those future profits more valuable today. And also what the Federal Reserve calls the portfolio balance effect, which is, if you're seeking, say, a 7% return target and your bond yield goes from 7% to 2%, you have to move up the risk curve into equities. So this is just over the last 10 years, the PE ratio of the S&P 500. And it's doubled. In fact, it's reached a level higher than it has ever been before, at around 33.5. And this is a theme I'm going to return to through this presentation. Whilst the S&P over this time has gone up 200%, around half of that can be directly attributed, as you can see here, to multiple expansion. So whilst obviously the companies underneath that index have generated significant earnings growth, around half of the return that you've enjoyed as a shareholder has come from multiple expansion, which is itself reliant on low and falling bond yields. So it's really important to remember that connection between bond yields and equity market valuation levels. The most extreme example of that has been the tech sector. Now, this is a slightly involved chart, but what I'm showing here is the earnings volatility of the tech sector in blue and the wider market in green. Now, you can see in the early 2000s, tech was significantly more volatile. They were high growth companies, quite uncertain prospects. Some of them went bust, some of them didn't. If you wanted bond-like equities, you went for Vodafone, because everyone pays 30 quid a month for their phone bill, or you went for National Grid because everyone pays 30 quid a month for their gas bill. Now, what you can see is that after the crisis, as these tech companies kind of moved more deeply into our lives, they started to offer a better prospect than the previous kind of consumer staples people. So whilst you might still be paying £20 a month to Nestle for all your consumer staples, you are also now paying 10 quid a month to Netflix for your film subscription. You're paying 10 quid a month to Spotify, and you're paying £10 a month to Apple for your iCloud storage. You're paying 10 quid a month to Microsoft for your Office 365. And tech companies now effectively provide the market with a very low volatility of their earnings. Why does that matter? Because it makes them seem much more like bonds. Now, they're not just ordinary bonds. They are, if you can conceive of such a thing, effectively bonds with coupons that grow over time. That's the world domination part of tech. That's the pricing power. It's an incredibly attractive prospect. Make absolutely no mistake about that. However, it's kind of been the only game in town. And as a result, basically people don't own anything else. This is just a measure of market concentration. So how much of the S&P 500, the US equity index, is accounted for by the top 5 stocks. And you can see in the 80s, some real old school companies there, all of them still around actually. It accounted for about 17%, and that was quite a high level. We moved through the 90s into the 2000s. So at the peak of the dot-com bubble, Cisco Systems, the kind of bridge to the internet, was a pretty big company, but still the concentration wasn't anything like what it is today, at 24%. And that does matter. The fact that the tech companies are really very good at what they do has not gone unnoticed. And I think it's important to observe. I'm not going to accuse any investment manager of back solving, but a lot of people's investment style, which revolves around identifying companies with moats and pricing power and high margins and free cash flow, has led them to the same companies. And let's have a quick look at some, top 10 holdings. These were literally the first 10 that I picked. You can see that the same companies are on quite a lot of those. It's Microsoft, it's Amazon, it's Apple, it's Adobe. what does that mean? It means that although these are fantastic companies, the valuation basis on which the market is treating them has risen pretty substantially. So you've got both the bond discount rate factor and the fact that growth stocks, the tech stocks, have offered you rising earnings in a time when the economy wasn't really growing that much. Let's pick, the most kind of well-known one of these, Microsoft. The multiple that people are willing to pay for Microsoft has gone from 10 times earnings in 2013 to around 40 times now. Now, Microsoft shares over that period have returned 700%. So, what a fantastic investment. And it's become one of the largest companies in the world. It's rightly very widely held. And it's important to admit that the size of these companies does mean that they will, by that alone, be well represented in top 10 holdings. But that 700% return, if you reduce it by the valuation expansion, i.e. by the fourfold increase in multiple, you're left with the earnings increase, which is around 300%. So more of your return as a Microsoft shareholder has come from the market being willing to pay more for future earnings, rather than the earnings themselves growing. Fine, again, that isn't something that we're here to kind of argue with, but just to illustrate the degree to which that is reliant on low bond yields. And a slight sidebar, the problem that we are going to face now is that the pandemic has brought forward an extremely large amount of tech spending. So whilst it might have made sense to pay, let's say, 40 times for Microsoft a year and a half ago, when you had the potential for working from home, for technology integration into more of your life to come, a lot of that demand has now arrived and is in the present day. So paying the same multiple for the expectation of higher future earnings is difficult. Now, got to be very clear about one thing here. The balanced portfolio of treasury bonds and US equities has been fantastic. Let's take a quick look at it. So in blue, you've got the MSCI United States, and in green, the Treasury long bond portfolio. And what an absolute dream. I've taken this from before the global financial crisis. So you've had a pretty serious hit in the equity market in that time. And the beautiful thing about bond equity correlation over this period is that it's been negative. So the volatility of your portfolio has been quite low. When equities have gone up, bonds have gone down, but not very much. When equities have gone down, bonds have gone up quite a lot. And over time, you've made fantastic progress as they've been negatively correlated, but trending positively together. Now, what you can see, just as we get to the end of this graph here, is that the equity market has continued to race ahead. And if you recall the shape of that market return, just the shape of the chart on the right, looks very similar to the valuation multiple expansion chart from a few slides earlier, i.e. a lot of that return has come from high multiples. Just as the bond market is starting to sell off. Now, I'm going to talk in the second half of this presentation about why we think it is that yields will rise from here, or might rise from here. But for now, all I want to kind of illustrate is that the balanced portfolio has got duration risk on both sides of the equation. So very obviously, the bond portfolio has duration risk, as we saw at the beginning, more duration risk than ever before, for lower reward than ever before. But the equity part of your portfolio also has very significant duration risk because of the degree to which investors have re-rated growth stocks in particular, which account for a larger percentage of the market than ever before. Again, illustrate the point a different way. It is low and stable inflation that has permitted this. So what am I showing on this chart here? On the x-axis, you've got CPI, and on the y-axis, the multiple of the market. And we are right at the top left-hand corner there. What does that mean? It means that irrespective of what inflation does, things are pretty pricey in the equity market. If inflation were to rise, all historical correlation tells us that the valuation multiple of equity markets should fall. So, irrespective of the earnings growth of these companies, irrespective of their future growth profiles, the headwind from that will be quite substantial. And really, it's my view, it's our view that the balanced portfolio is a dangerous thing to be holding right now, particularly it's kind of low risk, bond heavy representative. Now, what this means is that the balanced portfolio is fighting the last war. What do I mean by the last war? Well, a good example, I think, is to rewind to March 2020, when the financial system was imploding. I got a call from my mum saying, is my money safe in RBS? And the answer, as we all know, was of course, yes, it's absolutely safe. The government, the FCA, regulators around the world have spent the last 10 years making banks, which were the epicenter of the previous crisis, as secure as possible. You didn't have to worry about your deposits. You did have to worry about your assets in the market, but not your bank deposits. The other historical example is the Maginot Line, which was a defensive fortification built on the Franco-German border in the 1930s. It had guns pointing in both directions, a very, very solid bit of kit. And you can see that all the way along the Franco-German border, there were very, very strong fortifications. The French government put all their money into fortifying it rather than into a mobile army. To me, this is reminiscent or has relevance to the balanced portfolio of today, which is reliant extremely heavily on low and falling yields and stable inflation. And as we know, what the Germans did was just went through the forest to the north. I'm going to talk in the second half of this about why we think now is the time to be worrying about yields and inflation. But for now, I will hand back to Josh.
Thanks, Matt. That was very, very, very interesting. I've just probably got the two questions that sort of come to mind of what you just said so far. Is that, as you mentioned about inflation, well, what happens if you're wrong? Everyone was worried about inflation in 2008. They said inflation was coming, and yet inflation didn't materialize. So what happens if we're wrong about inflation?
Well, I'll give two answers to that question. The first is to say what's different to 2008, and the second is to say what happens if we're wrong about the arrival of inflation. 2008, what you had after the global financial crisis, and this is similar to why Japan isn't the relevant example for us to look at, is you had a crisis that meant that the household sector was deleveraging very fast. Everyone had too much debt. Their mortgage was too big and their house price was falling. The corporate sector was the same. They had taken on debt to expand an economy that then suddenly started shrinking. The people who were in reasonable shape were the government sector, basically, which started expanding with fiscal stimulus, and central banks, which provided a huge amount of liquidity. And they kind of cancelled each other out. And all credit to central banks for kind of skillfully managing that dynamic. What you've got now is same as before. Central banks, with the kind of tap fully open on the liquidity front, joined by governments in a size not seen since the Second World War. On top of that, the corporate sector balance sheet took a hit briefly in COVID, but has now been made whole by governments through all of the kind of coronavirus business interruption schemes. And the household sector has actually got a stronger balance sheet than ever before through kind of forced savings. So that's why I don't think that the credit crisis didn't lead to inflation narrative is wrong, because no one is hurting at the moment financially. This is the crisis that was no one's fault. So why shouldn't everyone be made whole? However, the variable here is government spending. If governments start to kind of pull back on fiscal stimulus, it will unequivocally slow the economy. All we can say is that, and that would lead to lower inflation. All we can say is that the focus of the government, particularly in the United States, is employment, specifically low employment. And they've said they will keep spending until employment rises. So looking at things through an MMT lens, the only kind of governor, the only thing restricting government spending is inflation. And that's what gives us the confidence that we have to position the way we do for inflation. We see its arrival as kind of inevitable, because governments will simply spend until it does turn up.
Okay, conscious of time. And then probably one, so you mentioned earlier about this concept of duration, how it applies to equities. We just get sort of a bit more color on what is duration and how it sort of impacts sort of equity and equity allocation.
Yeah, sure. So, I mean, obviously, duration on bonds is well known, and the longer your bond and the lower your coupon, the higher the duration of that bond. Austria, for example, has what it calls a century bond, so a 100-year bond, which obviously has a very, very high duration. Equities are effectively a discounted stream of cash flows into the future, just like a bond. The difference being that the certainty of those future cash flows varies considerably. Good companies, you're certain about the cash flows and the growth profile. Bad companies, less certain, but it can change. That's how the kind of equity structure works. But nonetheless, when you buy an equity, you buy two things: the profits in the future and the rate at which they're discounted, and the kind of present value of the assets in the business. Duration has been a tremendous tailwind for equities, because of the portfolio balance effect that I mentioned earlier, but also that the discount rate factor and falling bond risk premiums have delivered lower equity risk premiums as well. So, I think what's really vulnerable here is going to be those equities which offer the longest growth profiles, the furthest growth visibility, and that is the tech companies.
So if you have a portfolio of, say, sort of growth tech stocks and bonds, you're effectively doubling down the same bet. Would that be sort of...
That's exactly my worry. Yeah.
Brilliant. I think I sort of have my 5 minutes, so we'll go back to the main event, and I'll see you all at the end.
Great. So why is Mike Tyson relevant here? His famous quote is, "Everyone has a plan until they get punched in the face." And this summer, markets are going to be punched by higher inflation readings. Now we can kind of speculate as to what those readings might be, but let's say we get CPI of 3 to 4%. There will be a lot of debate about whether it is structural or transitory. And all the policymakers will be arguing that it's transitory, because it's very important to central banks and governments that their funding costs, i.e. bond yields, don't rise. So what I'm going to do is briefly make the case for why it's going to be structural and what that's going to do to your go. So first things first, great quote from Grant Williams: shortages are the first signs of inflation in the wild. Are there any signs of shortages? Well, here we go. This is the change in supply delivery times in the United States. Now, I could have put on here a chart of Google searches for patio heaters, and then my patio heater isn't here. How do I get one? We all know that the pandemic has caused trouble with ports, with shipping, but fundamentally what we're dealing with at the moment is a supply side kind of wrongly configured for what people want in a pandemic, and a demand side that has supposedly been through a recession, but is actually spending more than it ever has done before. And you heard from my colleague Alex Leonard 3-4 weeks ago about inflation, about portfolio dynamics. We have spoken at Ruffer as well about the issue of deglobalization and what it's going to mean. And this is my proudest chart of the day. This is a meme about supply chain issues featuring a major supply chain issue. We are seeing across all economic sectors very serious supply chain issues. Now, some of them are temporary. Everyone needs a patio heater suddenly, and some of them are more structural. For example, Mercedes are having to air freight engines direct from Germany to the United States. They can't keep up with demand there, and the shipping channel is essentially flat out. Volkswagen is having to air freight semiconductors from Taiwan to Germany because the Chinese have wrongly configured the demand structure. They thought everyone would want an Xbox last year. Turns out they want a car this year. And the problem is that all this does is increase prices. Initially, it increases prices to the company. And the big question this summer will be, do companies take that as a hit in their margins, as VW have pledged to do, or do they pass it on to consumers? And really, it's that latter outcome that we think is eventually more likely, and that really is what drives inflation. Is there any sign of respite? Just very briefly, a chart kind of showing the sort of situation in the manufacturing sector is as bullish as it has ever been, as measured by the composite ISM. So way above the kind of boom coming out of the dot-com bust, which we all think of the 2000s as a kind of incredibly bullish time for the global economy. We're well above those levels now, and for sure we will sink back, but the structural underpinning is pretty positive. So we can introduce the concept of the tankslapper, which the Americans call a speed wobble. It's a pretty dangerous situation to face on a motorbike. What happens is that if there's not enough weight on your front wheel, it starts to wobble, and it starts off small and becomes very, very, very large. The technical term, which I should probably be using, is an amplifying sine wave, and that is what we expect to come. It's what historical analysis will tell you has been the kind of hallmark of every inflationary surge on record. Price movements start small, they rise a little bit, and then they fall back again. They rise more strongly, and then they fall back again. And I think the most important thing for us to realize today is what that brings is uncertainty. It's not so much that you need inflation to turn up to drive bond yields higher, but that inflation uncertainty is enough to do it on its own. And that's, it's a very important difference. Markets have been in an extremely stable environment geopolitically, economically, since the fall of the Cold War, since the Berlin Wall, really, and that is beginning to change. So, what happens if that turns up, and what kind of portfolio do you need to survive it? So let's take a quick look at the 1970s, which gives us the perfect example of what did happen. You can see in green the US 10-year yield kind of seesawing higher, and IBM and GE but essentially halve in value, as that valuation multiple that the market is willing to put them on crashes down. No change to their earnings over this period. If anything, they went up. And these companies were the tech stocks of their day. I wasn't alive in the 1970s, but GE made light bulbs back then, and I kind of imagine that was pretty hot tech at the time. Is that something that has any relevance to today? We think it is, and it does. This is what we've seen over the last 12, 18 months. As the 10-year yield has risen in green, the performance of banks against tech stocks has risen. So the start of the pandemic looked like a lot of people were going to go bust, and everyone was sitting at home watching Netflix. You obviously wanted to own Netflix over a bank. That is now starting to reverse as people are leaving their homes and taking out loans to buy a house, to start a new business, to cater for all the different demands. So that's the kind of value growth setup that we think is going to be important. What does a tank slapper look like in real life? We think the 1950s is a pretty good example. Line that's sort of only just visible represents economic growth through that period. Falling, rising, falling, rising. Doesn't look at all like our experience of the last 30, 40 years of a pretty constantly rising economy. As you can see, value versus growth was an extremely dynamic allocation. You could not just sit there in pack. You needed to be nimble. You needed to be thinking at an asset allocation level, at a macro level, and not just sitting back with a balanced portfolio. So as uncertainty rises and economic growth rises, the growth premium that tech stocks have received, so the valuation multiple they get over and above the rest of the market because they offer growth in a low growth world, we think is set as growth becomes available more widely. On top of that, the value factor has never been at a lower ebb versus growth stocks. So you've got the macro being pretty supportive of higher bond yields, and so lower multiples, at the same time as the sort of the micro factors on value have never been more attractive. What do I mean by value? Well, it's quite a sea of thieves. We think that you want to own financial stocks. NatWest and Lloyds are amongst our largest holdings. Energy stocks like BP. Some of the harder hit stocks by the pandemic, like Aena and Vinci, who run airports, as well as the kind of more heavy duty old industry companies like Rome, who make semiconductors for the auto sector. And finally, and I guess this helps answer Josh's question about what if inflation doesn't turn up. Can we put our money into real assets and kind of hope that works in an inflationary time? Well, the answer is no. I think this is really, really important for diversification. real estate, infrastructure, forestry, all of these kind of real assets, inflation hedges have all benefited massively from falling interest rates. Anything that has done that well over the last 40 years is unlikely to be able to repeat the trick in real terms going forwards. The wobbles to the left, the times when the economy isn't so strong, we think that credit makes a great hedge. This is the yield on the lowest rated junk bond in the US, which is at record ever lows. Even as, we've got to be honest, the probability of business failures as the kind of reopening wobbles around is very high. So final thing I'm going to say today, Q1 was a dry run. It was a little microcosm of what's to come, a pretty benign one, but a little window into the future nonetheless. And we felt that the Ruffer portfolio performed, admirably. Strong contributions from the value equities, deliberately almost no allocation to tech and growth stocks. We do have duration in the portfolio in the form of gold and the inflation-linked bonds. Those are the negative contributors you can see. We also have derivatives that rise in value as interest rates do to help hedge that duration risk, and they made a material contribution to performance. So overall, Q1 was a very good time in which is a good time to look back at to assess whether your portfolio did what you thought it would do, because we think it's how things will look going forwards. So the Ruffer portfolio is positioned primarily for a structural increase in inflation. We think that we'll go through a period of reflation. So that's this summer, a reopening boom. That's what the equity book is primarily pointed at. Value stocks such as financials, energy, industrials, as I mentioned before, with the hedge of some deflation as a risk factor. I think, what are we saying? The sea has been very calm for 30, 40 years, and everyone has built their boats into those wooden speedboats that you always see in James Bond films, the ones that go incredibly fast. Ruffer, our all-weather portfolio is more like an icebreaker. It's pretty unnecessary amount of protection when things are mirror calm. But the sea is getting choppier. The fog is kind of setting in, and we think that our all-weather approach is going to be the best way to construct a balanced portfolio going forwards. Tom, over to you for Q&A.
Brilliant. Thank you for that presentation, Matt. And of course to Josh too. Before we move on to our Q&A session, let's quickly recap those all-important learning objectives. Matt and Josh have explained the changing role conventional bonds play in balanced portfolios. They've run through the current macroeconomic environment for equities. Matt spoke about this in terms of its effect on different asset classes in inflationary environments. And finally, they assessed how this relates to asset allocation decisions advisors will need to make in the near future. A quick note from me before we move on to the Q&A session. There's a Simon, Neil, and a John who are watching this who we can't quite identify properly in order to give them their CPD. So if that's you, could you please message Joe Gilby to confirm who you are to get your CPD? Thank you. Right, we have about 10 minutes available for Q&A now. We've had a fair few questions come through, but there's still time to get them in. So do type your questions in the chat function. And as I said earlier, if you prefer your question to remain anonymous, please just select my name from the drop-down list next to where you type your question. Right, I'll kick us off with one from John Orton. We kind of addressed this in the previous working lunch we held with Ruffer a few weeks ago. But Matt, how high do you think inflation could rise over the next 1 to 3 years? And how will that be a concern when looking at portfolio asset allocation, do you think?
I'm not sure that I'd be so stupid as to nail myself down to an inflation number. It'll go above target. Target is 2. I think for sure we know it'll go above that just on base effects, if nothing else. The thing is, none of us can answer that question. And what we really don't have an answer to is what happens if you give all of your citizens $2,000. What do they do with it? There's a kind of a great thought exercise. If you give everyone in stimulus checks, not sure of the impact on inflation. If you give everyone $1 million in stimulus checks, you can be pretty sure that strong inflation is the result. And we're somewhere on that spectrum. I think our work suggests that it'll head through 3-4% on CPI in the US, and probably similar in the UK. It's just going to be a really difficult time for policymakers to persuade everyone to look through that. It may be right to look through it, but I think the key point for us is that interest rates are unlikely to rise initially to reflect that. So the negative that you get on cash will worsen. That is exactly what the inflation-linked bonds we hold in the portfolio are for. As that dynamic gets worse, though, let's say inflation does start to keep picking up and the government doesn't pull back on fiscal spending, the bond market will eventually start to demand compensation, in the form of a higher risk premium, a discount to the current price. If the Fed, if the Bank of England bring in what they call yield curve control, if they try and stamp bond yields down, that is likely to see their currencies fall, which then feeds through into inflation again. It can get quite reflexive. And I think, we have a view on higher inflation structurally, but I think what is really important for investors to think about today is the change from inflation certainty. So that's low inflation certainty. It's been at 2% and we don't see it wobbling higher, maybe a bit lower, to an environment today where we just don't know. And when presented with uncertainty, investors like compensation for that in the form of a lower price. So that's higher bond yields and lower valuation multiples.
We've had a few kind of questions come in on the inflation theme. This is kind of a good follow-up from John Hutton Attenborough, who asks, is all inflation bad inflation? Which I guess is kind of flipping the coin on what you kind of answered there.
Yeah, well, are you a borrower or a saver? If you're a borrower, inflation is great because it effectively de-gears your position. If you're a saver, it's a disaster because it just slowly eats away at the real value of your capital. And it's our view that that's exactly why policymakers are trying to engineer inflation, is to enable a transfer of wealth from the saver to the borrower to try and deal with the debt problem. Good inflation is, anything that doesn't start to get reflexive, I would say. Good inflation helps nominal growth. It can actually help inequality because it tends to move money from the asset holder to the asset borrower, from the person with a 2 million quid ISA to the person with real negativity on their mortgage. Basically, too much inflation is when it stops being a good thing, because it gets very hard to control. The only way to control it is higher interest rates, and the impact of that on companies who do have high debt levels, on the housing market, on employment. It won't be that we're a long way off that, but that won't be a pretty choice to make. And history tells us that every time that they're faced with the first stirrings of inflation, policymakers don't worry about it because it's quite an inconvenient thing to have to deal with.
Yeah. You kind of segued nicely into my next question. You can answer this more generally. I don't think we're expecting you to predict the future. But Kevin Neal asks, when and in which order do you think central banks will reverse emergency base rate cuts they implemented 12 months ago?
I think the only answer to that question is when the market forces them to. When will the market force them to? When their currencies start depreciating. And that's, if you ask us for, if you talk to our chairman, Jonathan Ruffer, he says, do not worry about how inflation turns up. Just absolutely trust me that it will. And we sit there and can kind of be certain that he's right. It's sort of logical inescapability. Our CIO, Henry Maxey, who deals a bit more with the near term versus Jonathan's kind of structural views, his sense is that we will get continued fiscal and loose monetary policy getting wobblier. So let's explain this clearly. We'll have a boom over the summer in economic terms. As we head towards the winter, maybe we have some restrictions put back on. The government pulls back on fiscal, furlough is set to end at the end of September, and the economy dips again. It's at that point, the economy's slowing, government's pulling back. If the government decides, well, look, what is the problem with furlough? Why not extend it indefinitely? It's essentially universal basic income. Let's bring it in. Let's increase defense spending at the same time, pay rise for civil servants. There will be a tipping point when initially the bond market and then the currency market says enough's enough, and we're out. Capital will try and leave, and that is the point where the central bank loses its potency. It's basically the only constraint on central banks is higher inflation. That's why we think it's worth worrying about.
Okay, we've got about 30 seconds for you to answer this last one before we have to finish up. John McKeever, hello John, asks, what steps have you taken to take in the consideration of a drawn out impact from COVID-19? So a nice rougher base one for you there.
Yeah, it's got to be a risk. There are definitely deflationary risks. The productivity boom that working from home could enable, I don't know that it has yet, is a deflationary force that will extend the cycle. But really, if things get bad, then that's where we think the credit hedges that I mentioned briefly at the end will be really powerful. They worked extremely well in March, contributing enormously to the performance of the portfolio, which kept its head above water through the pandemic market crisis. If you get deflation at a time when debt levels are at record ever highs and optimism in credit is also at record ever highs, things could get quite ugly in credit markets for a while. We know the Fed stands behind them, but that doesn't stop prices moving in the first instance. And so that's why in our kind of deflation bucket, we hold things like credit default swaps to protect the portfolio against exactly that kind of, we can't rule it out.
Brilliant. That's not the brightest question to end on, but that's all we have time for today. Thank you for your questions, and thank you again to our two speakers, Matt and Josh, for a really valuable session. Now, before we close up, Josh, would you like to do the draw for those delegates that have asked questions to see who's going to win that case of wine?
Yeah, sure. Here it is. The winner is John Orton. So we'll be in touch to send you the case of wine.
There we go. Thanks, Josh. That was a very quick wine draw. And congratulations again to our wine winner. I think that was John Orton, Josh said. Before we sign off, let me just remind you of some dates for your diary in April that are on the screen now. At the end of this month, on the 28th and 29th, we'll be bringing you our 2-day ESG masterclass, where you'll hear keynote presentations from NextWealth's Heather Hopkins, Peter Toogood from the Advice Centre, and 2 experts from FE Fund Info, as well as 6 excellent presentations from Aberdeen Standard Capital, Bailey Gifford, Close Brothers, Goldman Sachs, Pictet, and Royal London. Altogether, that's a tasty 7 hours of CPD and all your spring fill of ESG. Then on the 12th of May, we have our next working lunch with Bailey Gifford on combating inflation and generating sustainable income. Before another working lunch on the 26th of May, as Julian Hitburn from Schroders discusses advising divorcees. So that's it for today's session. All that remains is for me to thank Matt and Josh once again from Ruffer for their excellent presentation. But of course, our biggest thanks goes to you, our readers, for your company this lunchtime. I trust you found this helpful and worthwhile. If you did, then we'll look forward to seeing you again soon. Goodbye.